I want to thank Clarkson University for hosting the webinar and assisting with this initiative for members, and St. Lawrence University for being a sponsor for this educational series. I'm very happy to introduce our presenter for our February Lunch and Learn webinar titled 2018 Business Taxes, What You Need to Know. Today we have Angela Gray from Gray & Gray Associates, CPAs, and PC that will help us understand the biggest tax bill since the Reagan era in the 1980s and how businesses can benefit from the new reductions. Angela is a certified principal in the firm of Gray & Gray Associates, certified public accountants. As a public accountant with over 15 years of experience, Angela assists individuals, small businesses, and not-for-profits with their financial and tax needs. Angela has been an active board member of the New York Council of Nonprofits, Canton-Potsdam Hospital Foundation, Seaway Valley Prevention Council, Traditional Arts in Upstate New York, the Grass River Heritage Area Development Corporation, the Young Women Leadership Institute, and the Rotary Club of Canton, New York. And with that, I will turn it over to Angela.
Thank you, Mike, and welcome everybody. Thank you for taking time out of your lunch today to learn about the 2018 tax changes. We are going to talk specifically regarding the business tax law changes. A little bit about our firm. We have 3 CPAs in the firm. I'm Angela, and we also have John and Aaron with a whole team of accountants that we have worked with in the past year to navigate this law. As I say frequently, there is no longer a normal. We have a big new normal. This is the largest tax reform bill since 1986. It impacts every individual and every business. So it's interesting, a lot of times we see these tax law changes, but they're hitting pockets of people, pockets of businesses. And this is the first one in a very long time that has left nobody untouched. One of the biggest recommendations I can make to you when you're navigating what is known as the Tax Cuts and Jobs Act and how these changes impact you either as an individual or a business is to consult with a tax professional. I think the idea in some respect was to make the tax code easier, but it certainly did not accomplish that goal. And one of the tidbits I'd like to leave you with today is we had a huge opportunity at the end of 2017 to do some tax planning with our clients. And if you haven't done any tax planning, I would really encourage all small businesses to start tax planning for 2019 so you can minimize your tax bill with the appropriate tax positions. There does come a time in the year when it no longer makes sense for tax planning. Unfortunately, you're just not left with enough time. So now is the time, even though we're just getting into the filing season for 18, to start thinking about your 2019 tax bill. So as you can see, what I'm going to bring up here is a partial list of changes that impacted businesses. And there's several changes listed. These are only a partial list of that. So one of the biggest changes was a brand new addition to the tax code, and it's code section 199A, and that is the deduction for qualified business income. So we're going to talk about that for a major part of this presentation, just because it does impact almost every small business in some respect that is a pass-through entity. The tax law also repealed the alternate minimum tax for corporations. AMT, as it's also known as, is a second taxing calculation, and taxpayers end up paying the higher of the two. They modified the corporate tax rates. They increased depreciation limits, which fall under sections 179 and 168, and we will talk about that. There was a modification to how you can deduct interest, modification of how we deal with net operating losses, and just a couple other small changes here with the limitation on the deduction by employers of expenses for fringe benefits, i.e. sometimes entertainment. And they repealed what was known as a domestic production activity deduction. That was section 199. They repealed that and replaced it with 199A. Domestic production activities adjustments typically impacted the construction industry, the manufacturers, software developers. So it was a very select group that received benefit from that deduction, but that's no longer there in 2018. There's also a prohibition of cash and gift cards and other non-tangible personal property as employee achievement awards. So those are some of the changes that I think impact small businesses in and around the North Country, but certainly impact all businesses on a national level as well. So jumping into the content today, one of the things we want to just quickly point out to is the C corporations got what some call a gift from the government. They are now taxed at a flat rate of 21%. Previously, C corporations could be taxed as high as 39%. So a significant reduction to some C corporations. They are now no longer subject to alternate minimum tax, so that's positive for them. So when they made this change for C corporations, they had to look at other business entity types and say, how can we help these businesses as well? So they came out with what's known as Section 199A. And as I said earlier, this is a brand new section of the tax code, and it's called the Qualified Business Income Deduction, and we abbreviate QBI to be Qualified Business Income. So in the case of when you determine on your return the qualified business income, we're now allowed to exclude 20% of pass-through income from taxable income. So if we pause there and we define what is pass-through income, this applies to domestic activity only, so in the United States, and as an entity, it impacts sole proprietors. They pay tax on their business on the personal return. Partnerships pass through the income to the partners, so that's partners, that's the pass-through right there. S corporations pass through the income to the shareholders, and trust and estates pass through the income to the beneficiaries. So those four items right there, sole proprietors, partnerships, S corps, and trust and estates, those are our pass-through entities that generate the pass-through income. If we are involved in multiple ones of these, so we may have a sole proprietorship and we may have an S corporation, we determine on a per business basis what the QBI is. And then the QBI, simply put, is limited to 20% of the income or 20% of the taxpayer's taxable income. So it on the surface becomes a very simple calculation, but there's a lot to this tax code. They passed it into law in December of 2017. There was a lot of confusion on some of the more complicated cases, and so the IRS issued proposed regulations in the August of 2018 timeframe. And they just issued the final regulations that we can use to apply to the 2018 taxes a couple weeks ago. So it's developing, it's brand new, and I think you can start to pick up on why you may want to consult with a tax professional in the case of having qualified business income. So looking at the next slide, very simple calculation. If I am the sole shareholder of an S corporation, and I net $100,000, so that's my pass-through income, I can exclude $20,000 of that from my taxable income on my personal return. But I also have to look at my taxable income because there's a limitation there as well, because it can't exceed 20% of my taxable income or 20% of my QBI. So I compare the two, and I get the lesser of the two. So maybe I'm a shareholder, I make $100,000, my spouse makes $50,000 working, and assuming, there's always adjustments there, but that we have $150,000 of taxable income, our 20% limit right there is $30,000. I take the lesser of the two, I'm limited to $20,000 as a deduction. Still, that's saving me as an individual a lot of income tax. Changing that example a little bit, let's say that I have qualified business income from my S corporation of $100,000, but due to losses elsewhere on my return or deductions for other items, I may come up only with taxable income of $75,000. So in this case, the 20% threshold is based on the lower of the two. So even though just looking at QBI alone would be eligible to $20,000, my taxable income is limiting me to only be able to take a deduction of $15,000. So that's the simple calculation of that. There's a lot more to this rule. Looking at the 2018 tax rates on the left, if you were to calculate the impact on the individual tax rates of someone who does have qualified business income deduction, you can see that if I'm in the 24% tax bracket, so my taxable income is ranging between almost 170 and 320, instead of paying tax at 24%, I'm going to end up paying tax at 19%. So, and it just goes forward from there. At the 22% rate, if I'm eligible for a QBI deduction, I would have a rate of 17.6. So obviously some dramatic reductions of the tax bill. And in the work that we've done in doing tax projections for our clients, we have seen this in practice. And so it's been very eye-opening, I think, for our clients to look at what they were paying versus what they expect to pay in this tax year, simply based on the QBI deduction. So it's, as an accountant would say, it's been kind of fun looking at these different things. So there are some special rules within this tax code. It's not all glamorous as it initially comes across to be. But you have to ask yourself, am I a specified service trade or business? The definition of that is that the principal asset of the business is the reputation or skill of one or more of its employees or owners. So how the lawyers let this bill go through like this, I will never understand, because we have a lot of them in our lawmaking bodies, but it's a trade or business involving the performance of services in the fields of health, law, etc., financial services, brokerage services. So if you're an attorney, a doctor, an accountant, some athletes, investment advisor, a broker, architect, all those different things where we rely on our personal reputation to make a living, we are subject to another set of thresholds on that. And so one of the things, if you fall in this category, there's the calculation can become extremely complicated. There is an income limitation, and you can completely phase out of the deduction if your income is too high. So for the single individual who is a specified service trade or business, and we use the acronym SSTB on that, if they're under 157,000, they get the full 20%, assuming their taxable income allows that. Between 157,000 and 207,500, we start to reduce the amount that we allow as a deduction. And then if the taxable income exceeds 207, they completely lose the deduction. And below are the married filing joint limitations on that as well. So some of the things that we've worked on in the past year are for our individuals who qualify as a SSTB and are falling in this range, a way that we can, if there's something that we can do, such as an investment in some equipment and bring the profits down to keep them within this range or below so that they are getting the benefit of that deduction. So as you can see, it's a pretty big planning point for lack of a better term, what we deem as professional services. So suffice it to say that the phase-out range of 157 to 2075 or 315 to 415 in the case of married filing joint can become a lot more complicated than multiplying just the income by 20%. When you're in this phase-out range, you have to look at the amount of W-2 wages that you've paid out in your company, and you also have to look at how much qualified property that you have. Both of those items have a multiplier, and you're always looking, in some cases, at the lesser of two numbers or the greater of three numbers, so it just depends on what part of that calculation that you're in. If you're a sole proprietor or partners in a partnership that are falling in the phase-out range and you don't have a lot of property and you don't have any employees, you may be at a disadvantage because you might be losing out on some of the deduction, because it then in the phase-out range becomes sort of a three-prong approach to how you would calculate that. So one of our recommendations is tax planning. This can assist taxpayers to get a strategy to maximize the deduction that they would be eligible for. And it could be the case of a professional who has always worked on their own and is thinking about hiring some staff. Maybe this is a good year to do it. And it brings me back to my original point at the beginning that we want to start thinking about this for 2019, because if we wait until September or October, the traditional tax planning time of year, we may be out of time to fully get a benefit from the maximum amount of the deduction. When you have multiple pass-through entities, which is very common with clients in our firm, where they may have a Schedule C and some rental property somewhere that qualifies as a business, and they could be a shareholder in an S corporation, you really need to meet with your tax preparer, meet with the professionals, because there's a lot of special considerations that should go into the QBI deduction if you have multiple pass-through entities. And it can get pretty complicated, and there's certain elections that need to be made in order to get the full benefit of that deduction. So the bigger the deduction, the more complicated the calculation. And I hope I haven't confused everybody on the call, but I hope that we've driven this home that you really do need to consult a tax professional to maximize this deduction. Prior to this law coming out, some might argue that a small business could prepare their own Schedule C. And this I think may be a game changer for some, because there's a lot to this code section. So how do we plan for the qualified business income deduction? And there are some steps that we can consider that we can take. In the situations where it's applicable and appropriate, we may want to look at converting subcontractors to employees in order to have W-2s reported by the entity. Just as a side note, I don't think the IRS would ever be critical of treating someone as an employee when they may be a subcontractor, but the vice versa is not true. Misclassifying a worker as a subcontractor when they should be an employee has certain negative tax implications. So, looking at that scenario to see if it does make sense, if the benefit on the tax return exceeds the additional cost, is a completely appropriate step to take in trying to just maximize a QBI deduction. One of the things we may want to do is invest in depreciable assets. So maybe we don't need the employees, but we want to make sure, especially if we're in that phase out range, that we have something that allows us to take the deduction. And that could be the depreciable assets and reinvesting equipment and property back into our companies. One of the big caveats to this code section is the IRS wants to know that S corporations and partners are taking reasonable compensation. Why that becomes important is, I'll try to walk you through an example verbally, which isn't always the easiest to do. But if we have an S corporation that is netting $175,000 before it pays its shareholders, the idea that might come to the mind is, well, let's just pay the shareholder 20 grand, and then we'll get the pass-through income of 155. So it's the 175 minus the shareholder compensation of 20, and we pass through $155,000. We get 20% of that basically tax-free. So why would I increase those shareholder salaries? The reason to keep your shareholder salaries reasonable is to be in compliance with the tax code. So all this research that we've done and the classes that we have attended and education that we have attended, this becomes a very big hot button to CPAs to consult with their clients to make sure they still are receiving reasonable compensation from their S corporations. And guaranteed payments are very similar in the partnership structure. Also, if you have a business that currently might be an LLC taxed as a partnership, and it's doing multiple service areas and also might have some non-service business in there, this might be the time of year to consider splitting those businesses out. Always be mindful that there could be tax implications of that split. But just trying to, again, look for ways to maximize a QBI deduction. And one kind of a strange thing is, for years and years and years in the tax code, and as I said, there really is a new normal. Usually clients will say, does it benefit me to do marriage filing separately? And previous to 2018, probably 9.5 or higher times out of 10, we would have said there is no benefit. But for the first time ever, the consideration of married filing separate versus married filing joint comes back on the table when we're trying to maximize qualified business income deductions, and we might have two high earning taxpayers. So just a new way of thinking, a new way of doing taxes. And I just want to point out to you that a lot of people think, oh, I'm getting 20% tax-free. I should become an S corporation. I'm currently a C corporation, or I'm an LLC, taxed as a sole proprietor, and I'm paying all this self-employment tax as well. Let's just go to an S corporation or some other pass-through entity. You really have to sit down with your accountant, your tax preparer, and say, does it make sense? And what entity structure does make sense? Does it make sense for me to pay 21% corporate as a flat tax? Or is it better for me to angle my taxes to maximize a 20% QBI deduction? If we're only paying 21% in a C Corp, does a pass-through entity still make sense? And is the S corporation the best entity for a specified service trader business of a high income earner? You know, years ago, our answers as CPAs may have been very quick to these questions, but there truly is, right now in the tax code, no one-size-fits-all answer, and special consideration should be given to a variety of factors unique to each individual and also unique to each business. And one of the ironic things is the Tax Cuts Jobs Act, everything expires in 2025, the way the law is written sitting here today. So this is a 7-year program, if you will, and so we're wondering what happens next. You know, so if we're planning only for 7 years, which is all we have to go on right now, what is it going to look like after 2025? So again, I can't stress to you enough that you should consult with a professional who's well versed in this niche, because it does apply to every business with a profit, and definitely something worth looking into. So we want to change gears a little bit, leave the topic of Section 199A, qualified business income, set that aside, change gears, talk about some of the other smaller changes in the business tax code. In the old law, we were able to deduct entertainment expenses that were directly related to the taxpayer's trader business, and they were generally deductible. So a lot of times, you know, you might get a box at the Montreal Canadiens games. You bring your client, you have a small 10-minute seminar beforehand, and you're just kind of entertaining them at the Canadiens game. We would be able to take 50% of the total cost of that entertainment as an eligible deduction. The new law, and also under the old law, in terms of companies, they might pay for golf membership dues or fitness fees, etc., to a club. Those were deductible as long as they were considered compensation to the beneficiary of that. So if my company paid my golf dues for me for the year, they would have to put them in my W-2, and then they could take the deduction for that, subject to 50%. The new law, in terms of entertainment, amusement, and recreation activities, doesn't allow for any deduction for those. There's no deduction for membership dues. And I just want to remind you that when we hear this, we often think of a 50% limitation on meals and entertainment. There still is a 50% limit on the meals, but the entertainment portion of that is no longer deductible. So what we've asked our clients that we've worked with on this particular topic that maybe had higher entertainment expenses is to break out the entertainment piece on the general ledger and the meal piece on the general ledger, so there is no guessing and we can clearly see what's deductible and what's non-deductible. So we also in business have this situation that arises when deductions exceed gross income and we arrive at an operating loss. Under the previous tax code, we were able to take those losses back 2 years, and we could get a refund of prior year taxes equal to the tax on 100% of that loss. So what that looks like is in year one, I made $80,000. I'm a C Corp. I paid a hefty tax bill. In year two, I had a bad year, maybe due to environmental changes, lost a bunch of money. And let's say that I lost $60,000 in year 2. So year 1, I have an $80,000 profit. Year 2, I have a $60,000 loss. Under the old rules, I used to be able to file a form that would apply that $60,000 loss against the $80,000 of income in the year before and request a tax refund from both the federal and state governments. And so if I didn't carry that loss back, I would take it forward 20 years. If I lost money for the next 20 years and I was still in business after losing money for 20 years, I would just lose those losses. They would just fade away, and I would never get the advantage of that. The new law changed that, and the losses are no longer allowed to be carried back 2 years. So that completely comes off the table, but they are allowed to go forward, and they go forward indefinitely. So there is no expiration of net operating losses, but we're only eligible to deduct the loss limited to 80% of the taxable income. Thinking back to Section 199A, we're only paying tax on 80% of our income. So that was kind of the how they equaled that out, and that's where that 80% limitation comes in right there. So that was a change on the net operating loss rules. The old rule of carry back 2, forward 20 has been there for a very, very long time. So again, it's upsetting. You know, accountants aren't really known for liking change, so it's kind of disrupted that apple cart a little bit, but we're adjusting to that. We also have depreciation rules. So depreciation is a very tricky part of the tax code. The underlying, because there is so many ways to depreciate an asset. So the underlying rule says if I buy an asset that has a useful life of more than 1 year, I have to depreciate it. And the government determines what my useful life is. So if I bought a vehicle, I'm a 5-year asset. If I have a brand new piece of heavy equipment, 7 years, and the years go on up to over 30. So there is an asset classification schedule, which the government says these are the years and number of years that you have to depreciate this asset. In the first year, the government has in the tax code, Section 168. This has been around for probably almost 20 years at this point in time, I believe. It kind of came up with 9/11 as a way to stimulate the economy. And so we have, it's called bonus depreciation. And this is additional first-year depreciation that we can take on an asset. It's fluctuated throughout the year. It's been 50%, it's been 100%. But in 2018, before the Tax Cut and Jobs Act was introduced, the old law said that we would take a deduction equal to 40% of the cost of new qualified property placed in service during the year. So if I went out and bought a used truck, I could not take bonus depreciation. But if I bought a brand new truck, I was eligible to take bonus depreciation. This was set to phase down from, it started at 50% in 2017, and it was expected to go to 0 and just become unavailable in 2020. So the Tax Cut Job Act left virtually little untouched, including bonus depreciation. And in 2018, we now have a deduction equal to 100% of the cost of the asset. But they also roped in there for the first time in the legislative history of this code section, new and used qualified property that's placed in service during the year. And furthermore, they expanded the definition of what the tax code considers qualified property, so that they've made it more business friendly in that respect. This is expected to phase down from 100% and be completely done away with in 2027. One thing to note about bonus depreciation is if you deduct that on your federal return, New York State does not allow that deduction in most instances. So it's a good federal tax planning tool, not necessarily the best New York State tax planning tool. So the next one, depreciation section that I think a lot of small business owners are probably very familiar with is Section 179 expensing. This is an election that we make and say, okay, we know we have a new truck. We know we're supposed to depreciate it over 5 years and take a little bit of it for the next 5 years on my tax return. but I'm going to make an election to depreciate that entire asset in year one. So prior to, again, the Tax Cut and Job Act getting put into place for 2018, we had a limitation of $510,000 on qualified property. And unlike bonus depreciation, this could be new or used property. If we put into service and we did a big plant expansion and it ended up costing of qualified property over $2 million, we would start to phase out dollar for dollar the amount of eligible 179 expenses. So December 2017, we change all this and we say, okay, instead of having a $510,000 deduction, we have a limitation of $1 million. This has ranged throughout the years. I mean, to give you an idea of the changes surrounding this code section, I mean, this has been below $20,000 in the history of the code section, and now it's up to $1 million. So a lot of change in this. The phase out threshold under the new law is $2,500,000, and it did also expand the definition of what was eligible property. So property that's used to furnish lodging is now included, and the real interesting one has been the specified improvements to non-residential real property. Under previous tax code, we could not Section 179 a roof. We're now eligible to. An HVAC property is considered building component, so it had a very long useful life and was ineligible for Section 179, and that now is eligible as a deduction in the current year using Section 179. The good news about 179 is that New York State also allows this. In the case of SUVs over 6,000 pounds, there is a modification on the New York State return, and they have a limit different than the federal government, but it's still pretty hefty, and it is allowed, generally speaking, on the New York State returns. So one of the other, switching gears a little bit here, is for our partnerships. There's a new rule that was addressed with the law changes recently, and that gives extraordinary authority and autonomy to the partnership representative. So we've always had in partnership with a tax return tax matters partner. They came out with the concept of the partnership representative. And for the first time in 2018, the IRS can assess and collect taxes directly from the partnership rather than the individual partners, which is a big change from the whole concept of how the government gets taxes out of the partnership. So one of the things that you have to do on your partnership return is you have to each year designate who your partnership representative is. We've already designated the tax matters partner in prior years, but we now have a new role, and this person is the sole advocate of the partnership in all dealings with the IRS. One of the things is if you don't want to be part of this new regime, for lack of a better word, you can elect out of this on the partnership return. And you would do this, I believe, on an annual basis. So this is something, if you're a partnership, I think it kind of goes a little bit unnoticed. We sometimes have partnerships in this area that aren't bound by a formal partnership agreement. More reason to do so, and you should be looking at your operating agreements, making sure they're updated to be in compliance with this law, and definitely something you want to discuss with your CPA or attorney, I should say. So I'm open to questions. I know that's a lot of information, and we just hit some of the highlights of that tax bill for businesses, but I will open it up for the last 15 minutes for Q&A.
Thank you, Angela. That was very informative.
You're welcome.
We appreciate your insights and expertise in all the tax laws that you went through. I just want to encourage everyone on the webinar to chat your questions in the chat box if you have any. We'll stay on the line here for a few minutes to see if any of those come in. Well, while we wait to see if we do receive any questions, I wanted to let you know that we have our next webinar on March 6th, and it is titled So You're Interested in Government Contracting. And that will be presented by Amber Stevens from the Procurement Technical Assistance Center. And she will present on the basics of setting your business on track for government contracting. If you have any topic ideas for our next webinar, please feel free to use the chat feature to send them to us. We'll be working on recruiting a speaker for the April webinar, and we're always interested in presenting on topics that our chamber members find interesting and useful. So we haven't received any questions so far, so I think everyone is probably just trying to digest this information, which is understandable. So I wanted to just, take a minute again to thank you, Angela, for your time today and speaking and sharing some of your insights and expertise with us, as well as Clarkson and St. Lawrence University for sponsoring these series. We really appreciate your time. Also,
Thank you.
For webinar recordings, you can go to slcchamber.org and click Archived Webinars on the right-hand side to view all of our past webinars. We'll have this one posted in about a few days. And actually, we have one question. So Angela, what are some good websites or resources for finding out more information, just to kind of orient themselves before contacting an accountant?
Good question. And I would rely on, as a first place, the IRS website. So that's irs.gov. Their content is very, despite a significant shutdown in the federal government, their content is usually very relevant and very recent. And when you're on the IRS's website, there are, at the bottom in italics, it'll tell you the last time the IRS has updated that website. So on some of these topics, you can see that the last update was in the summer of 18 and even as recent as probably mid-January of 19. So the IRS is certainly a great website. You do want to be careful because in this case of Code Section 199A, we've watched this kind of develop for the last 14 months since the law was introduced. You want to make sure that you're on a reputable site and that it has language speaking to the final regulations that just came out. And so some of the state accountancy websites, so we have the New York State Society of CPAs, they may be posting something about this. The AICPA, which is the National Association Institute of Certified CPAs, they would have some information regarding that. But I would really stick to probably the government's website, the irs.gov, because that does have the most, that would be the most trusted source for some of these topics.
Great, thank you, Angela.